Right now, millions of Americans are asking the same question. Will my Social Security check actually keep up with my bills next month? If you've noticed your grocery costs climbing, your prescriptions getting pricier, or your utility bills taking a bigger bite out of your budget, you're not alone. The Social Security Administration just announced critical changes for October 2025, and what you're about to discover could directly impact your monthly income. We're talking about specific payment adjustments tied to the latest cost of living adjustment, potential eligibility shifts that might affect your benefits, and payment schedule changes that could alter when your money hits your account. But here's what matters most. Not everyone qualifies for these increases the same way, and some recipients might see bigger changes than others based on when they started claiming benefits, their work history, and their current payment tier. Whether you've been collecting benefits for decades or you're approaching retirement age, the next few minutes could help you understand exactly where you stand with these October changes. No speculation, just the facts you need to plan your finances confidently. Let me start by breaking down what's actually happening with Social Security this October, because there's a lot of confusion swirling around, and you deserve clarity on something this important to your financial well-being. The Social Security Administration operates on a very specific timeline when it comes to implementing changes, and October has historically been a significant month for benefit adjustments. What we're seeing this year follows a pattern that's been established over decades, but with some unique twists that make it particularly relevant for anyone currently receiving benefits or planning to claim them soon. The foundation of these changes rests on something called the Cost of Living Adjustment, which most people know as COLA. Now, this isn't just some arbitrary number that bureaucrats pull out of thin air. The calculation involves tracking inflation through a specific metric called the Consumer Price Index for urban wage earners and clerical workers, or CPIW for short. The government measures price changes for a basket of goods and services that includes everything from food and housing to medical care and transportation. When prices go up across these categories, the COLA is designed to help your Social Security benefits keep pace with those increases, at least in theory. The percentage increase gets applied to your base benefit amount, which means someone receiving $1,500 monthly will see a different dollar increase than someone receiving $3,000, even though they're both getting the same percentage boost. What makes October 2025 particularly interesting is how this adjustment interacts with Medicare premiums, because most Social Security recipients have their Medicare Part B premiums deducted directly from their monthly checks. There's actually a federal law called the Hold Harmless provision that prevents your Social Security payment from decreasing year over year solely because of Medicare premium increases. This protection means that if your COLA increase is smaller than your Medicare premium hike, you're shielded from seeing an actual reduction in your net payment. However, this protection doesn't apply to everyone equally. If you're a higher income beneficiary, if you're new to Medicare, or if you're not yet enrolled in Medicare, you might not have this safety net, which could mean your effective increase feels smaller than expected. Now let's talk about who actually qualifies for these new payment amounts, because eligibility isn't as straightforward as just being on Social Security. Your qualification depends heavily on when you first started receiving benefits and what type of benefits you're collecting. Retirement benefits, survivor benefits, and disability benefits all get calculated differently, and they don't all adjust at the same rate or the same time. If you started collecting retirement benefits before full retirement age, your base amount was already reduced, and that reduced amount is what gets the percentage increase applied to it. Someone who waited until age 70 to claim benefits is working from a much higher base amount, so their dollar increase from the same percentage adjustment will naturally be larger. This creates a widening gap over time between early claimers and late claimers, which is something many people don't fully appreciate when they're making that initial claiming decision. The payment schedule itself operates on a system that most people find confusing at first, but it's actually quite logical once you understand the pattern. Social Security doesn't send everyone their money on the same day, because that would overwhelm the banking system and create processing nightmares. Instead, Your payment date depends on your birth date. If you were born between the 1st and 10th of any month, you typically receive your payment on the second Wednesday of each month. Those born between the 11th and 20th get paid on the third Wednesday, and people born between the 21st and 31st receive benefits on the fourth Wednesday. There's an exception for people who started receiving benefits before May 1997 and for those receiving supplemental security income who generally get paid on the first of the month. Understanding this schedule is crucial because if you're budgeting around specific due dates for your bills, you need to know exactly when your increased payment will actually arrive in your account. The actual dollar amounts people receive vary enormously based on their earnings history throughout their working years. Social Security calculates your benefit using your highest 35 years of earnings, adjusted for inflation. If you didn't work a full 35 years, those missing years count as zeros in the calculation, which can significantly reduce your benefit amount. The system is progressive, meaning it replaces a higher percentage of pre-retirement income for lower earners than for higher earners, but higher earners still receive larger absolute benefit amounts. For 2025, the maximum possible Social Security retirement benefit for someone claiming at full retirement age is around $3,822 monthly, but very few people actually receive that maximum amount because it requires having earned at or above the Social Security wage base for at least 35 years. When we look at the October changes specifically, it's important to understand that any COLA increase doesn't just affect your current monthly payment. It also affects your future earnings potential if you're still working while collecting benefits. There are earnings limits if you're receiving benefits before reaching full retirement age, and these limits adjust annually for inflation as well. For 2025, if you're under full retirement age for the entire year, you can earn up to $23,040 before Social Security starts withholding benefits, and they withhold $1 for every $2 you earn above that threshold. In the year you reach full retirement age, the limit jumps significantly higher, and the withholding rate becomes more favorable at $1 withheld for every $3 earned above the limit. Once you reach full retirement age, there's no earnings limit at all, and you can earn as much as you want without any benefit reduction. The October timing also coincides with Medicare's annual enrollment period, which runs from October 15th through December 7th. This creates a critical planning window because any changes you make to your Medicare coverage during this period will affect your premiums starting January 1st, and those premium changes will impact your net Social Security payment. If you're currently on Original Medicare and you're considering switching to a Medicare Advantage plan, or vice versa, you need to factor in how those premium differences will affect your monthly cash flow. Some Medicare Advantage plans have zero premium, which means you'd only pay the standard Part B premium, while others charge additional premiums that get deducted from your Social Security check. Understanding this interplay between your Social Security adjustment and your Medicare costs is essential for accurate financial planning. Another critical aspect that affects qualification for the new payment amounts involves your work history and whether you paid into Social Security consistently throughout your career. Some government employees, particularly those who worked for state or local governments, may have been covered by different pension systems instead of Social Security. If you're receiving a pension from work that wasn't covered by Social Security, you might be subject to something called the windfall elimination provision, which can reduce your Social Security benefit. Similarly, if you're receiving benefits based on your spouse's work record and you also have a pension from non-covered employment, the government pension offset might reduce your spousal or survivor benefits. These provisions can significantly impact your benefit amount and how much of the October increase you'll actually see in your net payment. The taxation of Social Security benefits adds another layer of complexity that affects how much money you actually get to keep from any increase. Depending on your combined income, which includes your adjusted gross income, any tax-exempt interest, and half of your Social Security benefits, anywhere from 0 to 85% of your benefits could be subject to federal income tax. If you're single and your combined income exceeds $34,000, or if you're married, filing jointly, and your combined income exceeds $44,000, up to 85% of your benefits become taxable. This means that a COLA increase could potentially push you into a higher taxation threshold, reducing the net benefit you receive from the adjustment. Some states also tax Social Security benefits, though most don't, so your state residency plays a role in your after-tax benefit amount. For those receiving disability benefits through Social Security disability insurance, the October adjustments work somewhat differently. Your benefit amount is calculated based on your average indexed monthly earnings, similar to retirement benefits, but the qualification criteria are much stricter. You must have a medically determinable impairment that prevents you from engaging in substantial gainful activity, and this condition must be expected to last at least 12 months or result in death. The substantial gainful activity threshold also adjusts annually, and for 2025 it's set at $1,620 per month for non-blind individuals. If you're receiving disability benefits and you're approaching full retirement age, your benefits automatically convert to retirement benefits at the same payment level. So any COLA increases you receive while on disability carry forward into your retirement years. Survivor benefits represent another category that gets affected by these October changes, and the rules here can be particularly complicated. If you're receiving benefits based on a deceased spouse's work record, your benefit amount depends on several factors, including the age at which your spouse claimed benefits, the age at which you're claiming survivor benefits, and whether you're also eligible for benefits based on your own work record. You can actually claim survivor benefits as early as age 60, or age 50 if you're disabled, but claiming before your full retirement age results in a reduced benefit. The strategy around survivor benefits versus your own retirement benefits can be incredibly nuanced, and any COLA increases apply to whichever benefit you're currently receiving. The whole system is designed to be self-sustaining through payroll taxes, with current workers funding current beneficiaries. The Social Security wage base, which is the maximum amount of earnings subject to Social Security tax, also adjusts annually, and for 2025, it's set at $174,600. This means that someone earning $200,000 only pays Social Security tax on the first $174,600 of their earnings. These taxes, combined with income from the Social Security Trust Fund's investments, fund the benefits being paid out today. Understanding this financing mechanism helps explain why COLA increases are so carefully calculated and why there's ongoing concern about the program's long-term sustainability.